So I'm Nick Pititto. I'm a financial advisor with Prudential Financial. What I handle specifically for my clients, I act as a fiduciary in their best interest, managing their investments, managing their tax situation, managing their estate plan, their retirement plan, their income planning and cash flow going forward. So I'm involved in a lot of different aspects for clients, mitigating different debt situations, any questions regarding cash flow and debt consolidation. And I'm able to leverage a lot of our group here at LIPN, all the different resources that we have here, whether it's estate planning, whether it's real estate transactions, whether it's insurances, whether it's, all the different aspects we basically have covered in this group. And as we continue to grow, it's only getting better and better. So, obviously planning in general, that covers a lot of different topics, but what do I specifically focus on with the majority of my clients is estate planning and tax-efficient investing. Tax-efficient investing is something that, of course, I could go over today briefly. It's a little more in depth, but the brief overview of it basically is a concept called asset location. And it's something that a lot of advisors don't really touch upon. A lot of people just think of investing is investing, right? So typically when you're designing a plan, you're going to have some sort of risk tolerance that you fall into. If you're an aggressive investor, someone like myself, I'm young, ambitious, saving lots of money, right? If I'm aggressive and I have a long-term timeline, then obviously I'm taking more risk than your more conservative investor, or maybe someone in their older age or retirement years, right? So there's always going to be a mix of stocks and bonds when you're investing, really as a natural hedge, right? So when you're designing a portfolio to be designed for someone's risk specifically. So like I said, myself, more aggressive, I would have, let's just say, for example, 80% of my money would be in stocks, 20% of it in bonds. So if I had two different types of accounts that had different taxation, and this is where obviously this is the more advanced level, is when you're tying tax into a plan, this is where this concept comes into play for tax-efficient investing. So let's say I have an IRA or a 401k, which is basically the same thing from the standpoint of tax. Every dollar that comes out of that account is going to be taxable at ordinary income rates. And let's say I have a non-qualified account, which those of you who are not familiar with the lingo is basically just a bank account with investment capabilities, sort of like a brokerage account. You could open it anywhere. You could go to E-Trade. You could do it with me. You could do it at any company, basically. You can open either of those accounts, an IRA and a non-qualified brokerage account. Now, the difference with tax-efficient investing, like I said, it's asset location. So it's where you are specifically holding your stocks and where you are specifically holding your bonds. If you have one asset that's going to be taxed inefficiently, like an IRA, it's going to be taxed at ordinary income rates. You have one asset that's going to be taxed efficiently, like a non-qualified account. Those accounts, every dollar you take out is technically return of principal until you get to your gains. And then when you get to your gains, if you've held your positions for more than a year, or if you're collecting dividends that you've held the position for over 60 days, you can qualify for a lower tax. It's called long-term capital gains. It could be 0% for some people, it could be 15% for the majority of people, and 20% for your higher income earners. Whereas ordinary income, as we all know, I think the lowest bracket now is either 10 or 12%, and then it scales up pretty rapidly from there, 22, 24, into your 30s. So on the more tax efficient side, you have your non-qualified accounts, which you can take significant advantage of. So where would you put your stocks? Would you put your stocks, which are your biggest growers, are you going to put those in your IRA, or are you going to put those in your non-qualified account? It's It's pretty straightforward. You would put them in your most tax-efficient account. You would put them in your non-qualified account. Where are you going to put your bonds? Your bonds are your more fixed, slower-growing assets. Those you're going to want to put in your IRA. Now, like I said, I may still be that same balance, that 80% aggressive, 20% conservative, right? And when you put it all together, let's say the math just worked out perfectly, right? Let's say I have $100,000, 80% of my money I'm going to put in stocks in my non-qualified account, and then 20,000 of my money would be in my IRA in bonds. Let's just say the math worked out perfectly that way, that I happen to have $20,000 in an IRA and $80,000 in a non-qualified account. It would work out perfectly from the standpoint of taxability and tax efficiency for me in the long run, keeping my taxable assets as low as possible and my more tax efficient assets as large as possible, so I can take advantage of that significant tax break in the long run. So that's just the basic overview. I don't know if we're glazing over at this point or if that made any sense at all, but that's the basic overview of tax efficiency when investing. You're gonna take your more aggressive investments, make sure that they're more tax efficient. Your less aggressive investments, make sure that they're in the accounts that aren't going to be taxed as favorably. So when you apply this to a client situation, of course, when you're dealing with larger numbers, when you're dealing with larger tax bills, and you're dealing with clients who, at the end of the day, the bottom line for them is how much money is in my bank account and how much money am I paying to the IRS. This is a critical part of a plan. So it's typically something that's overlooked because everybody always looks at the bottom line. What was my rate of return, or what was my dividend yield? But really what the important part is what are you actually keeping in your pocket? What are you keeping in your bank account? And when you apply this to a plan, we've ended up saving clients thousands and, probably millions of dollars at this point if you were to add up all of it, right? So basically, this is how I apply it to my practice. It's every client is on a case-by-case basis. Like I explained, I work as a fiduciary. A fiduciary is someone who works in their client's best interests, which you would imagine would be a given as a financial advisor, but unfortunately for some financial advisors, they choose to work on a suitability basis or on the standpoint of having a product and recommending based on that product rather than making a recommendation based on what their client truly needs, what their client's goal is, really working through the personal side of things where a computer or a regular, online platform is not going to give you that tailored advice that's custom fit to your estate plan, custom fit to your tax plan, and all the other aspects of a financial plan. So that's where the human aspect of things comes into play. Very glad to be back in the office and meeting with clients post-pandemic here, or if it's still going on, obviously. In New York, it's kind of calmed down. So basically, that's what I cover. Estate planning as well. Working with our estate planning attorney, Massimo Santoli, in the group, covering whether it's a Medicaid need, whether it's how to tax efficiently leave an inheritance, whether it's providing a special needs trust to someone disabled in the family, let's say somebody in the family who's unable to work and support themselves. How do you properly leave that individual assets? What's going to be the proper way to set up my will? How will I be protected if I become chronically ill? Things along those lines. John DeAngelis obviously has an amazing amount of experience with these situations. So having him as a referral source in our group is incredible. So setting up all these different plans for clients, this is the conversations I'm having on a day-to-day basis, and meeting with anywhere from 10 to 20 clients a week and discussing their overall plans and going through what they're going through. with them, really, understanding that blood and money are basically the same thing when you're doing a financial plan, and it's very tied in and emotional and important for my clients that I'm acting in their best interest. And I take this very, very seriously. And the more clients I can support and help, obviously that's going to be my ultimate goal in the end. And my purpose is to help as many people as possible. So with the help of this group, I'm able to achieve that. And I thank you all for your time today.